The broadcast is now starting. All attendees are
Hello
in listen-only
everyone,
mode.
welcome to today's... Can everyone hear me to start off with? Okay, great. Thank God people have come back. Yes, but please bear with us. This is now, we haven't got the excuse of it being our first webinar, but it's still just only our second webinar, so we will try and get better at it. Welcome to today's webinar. Today is more of a market update webinar, talking about what's been going on in the markets. Of course, there is only one story, but we'll try and get through a few other different ones as we go through. But this one will be every Thursday, and it will be about the markets, a few trading opportunities, a few things we've been looking at a few of the charts and some levels, and just a few things that myself and George, who will be doing some of the other webinars, have been looking at over the last week or so. We'll have a little look forward to next week, see if there's anything that we're looking to there as well. To see if there's anything in the next week which we should be keeping our eyes on. But of course, at the moment, it does very much seem to be the same old stories and the same old stuff. The way we'll do it is we will run it for a certain amount of time, maybe around a half an hour or so. If you'd like to ask questions, please ask questions as we go through. We do have a Q&A session at the end, but if there's any questions that you do have as we go through, or is any charts or currencies we want to look at, if I know about them, I'll answer your question. If not, then we'll be tougher. But of course, we do have an email address that you can send emails to, and if you have any questions from there, we'll take it after the webinar, and we can get back to you from that point of view as well. We have done one webinar already. We did identifying trading opportunities on Tuesday, and these webinars are going to be running twice a week. So there'll be a more educational one on a Tuesday, and then there will be a market roundup on a Thursday. So this is the first weekly market roundup. So we'll get going now. Of course, the major stories that everyone has been talking about is the Eurozone and what's been going on there. And of course, this is dominating where the markets have been going recently. And I think it's very hard to look away from this situation at the moment, and anything else that's going to be moving the markets is really going to the back burner, and one of the prime examples of that is when we saw the non-farm payrolls come out a couple of weeks, and it was completely pushed to the back burner. So it's going to be interesting to see exactly what happens going forward over the next few weeks, whether the Eurozone really does become the major one, or whether the major story still, or whether we move away and see if we can almost any other parts of the markets will come to the fore and really show us any signs of trading. But we have had a few things which have snuck through, and maybe we'll talk about those things that have slipped through the radar to start off with. A few people have been looking at, and one of those, of course, is the fact that the US markets are doing that bit better at the moment. We have started to turn around, and we talk more about the economy, mate, than the markets. If we look 3 months ago or so, we were looking at how the fact that we were most probably going to go into a recession. We were looking at unemployment being terrible, the growth figures being poor as well. So it's something that's going to rumble on, of course. And everyone was thinking that after the Eurozone issue had gone away, we'd be then looking to that there'd be no respite, because the US would be the next issue, the next problem on the horizon, and that the markets really weren't going to have any kind of pickup whatsoever, because we just got problem after problem after problem. Now, the issue there, we most probably do still have problem after problem after problem, but the next problem doesn't necessarily look like it is going to be the US. It's just going to be that the Eurozone problem is even bigger than what we all thought. But what we've also had over the last few weeks or so has been some really good corporate earnings figures. Now, the Q3 earnings have been, I think the number was around 75% have beaten expectations. Now, these weren't really high expectations, and that takes you back a few years ago to the financial crisis then, where everyone was saying, well, okay, we've got markets really dying, nothing's necessarily happening. But all of these corporate corporate earnings are coming in better than expectations, but expectations were for a loss of $3 billion, and they come in and you've lost $2 billion. You can't exactly say that that's fantastic news. And again, we haven't got high expectations with a lot of these corporate earnings at the moment, but still they're beating expectations, and that's something which has been moving, has led to a few people looking away from the Eurozone, trying to get a few more in the way of positive news, because of course it's very easy if you want to find some negative news out there. All you have to do is turn on the television and you'll see Eurozone stuff. But of course, if you want to dig a little bit deeper, you've got corporate earnings, some more economic data US-wise, which has been doing that a little bit better. So it's going to be interesting to move on into Q4, see how things go from that point of view, and from an economic point of view, an economic standpoint, and how these economies are recovering. Christmas is going to be another key one, just to see what sort of trade people get, how well how consumers are feeling about the economy, by what is spent over the Christmas period. And of course, this for retailers is going to be absolutely massive, and from an economic point of view, it's also going to be pretty big as well. So again, looking towards those over the next few weeks or so is going to be really important. But of course, we won't get corporate earnings from a lot of the retailers, especially over Christmas or about Christmas, until the new year, and that will really give us an idea. But we have those big days in the US where people go out shopping, the days after Thanksgiving being the big one, and also the online trading day, which they call Cyber Monday, where people online shopping is the biggest day for online shopping before Christmas as well. So everyone will be looking towards those. But of course, the big story is the Eurozone. We can't necessarily get away from that, and that is what's been dominating the markets. Now we're looking at the screen you've got up at the moment is our MT4 screen. We've got a euro-dollar chart on there at the moment, and then something we were looking at in the webinar on Monday actually was the performance and the Fibonacci retracements that we've got on here at the moment. Now we were looking at this move from around the end of September time, the lows in September to the lows at the end of October. The highs at the end of October, and we were looking. We'd seen the big movement to the downside. We'd seen this negativity surrounding again the eurozone, the Greek referendum, which saw or the announcement of the Greek referendum, which saw markets really plummet, the euro take a hit. But we were saying to watch out for that 61.8% retracement. That was the big number that we were looking at, and we said that with these Fibonacci retracement numbers, what you will often get is a small break, and you look for a turnaround around those 61.8% levels. And of course, that is exactly what we've had. We have had this turnaround, and as you can see, this is a daily candlestick chart that we've got open here, and we have seen this push back higher yet again. We were holding around the 50% level, and we were saying that there was all this negativity would mean that we most probably see a move back lower. We did see that move come in aggressively. Of course, we've had all the news about Italy, and we'll talk a little bit more about all those situations in a moment or so. But as the market came down, we did see a break of that 61.8%. The move has turned itself back around and done that little bit higher. Just had a question come through: do we think the euro dollar is going to hit back up to 138 today? Now it's a bit of an optimistic one. I think. I don't necessarily think there's enough good news for a big move like that. But we will. But I think that this is a bit of a cop out, most probably. But I think the problem is at the moment you just really haven't got a clue with all this volatility. Now I'm going to show you something that we showed on Monday as well. Tuesday as well, which was this the VIX chart. Now this is really showing us exactly how this volatility has been moving around recently. And again, we showed this Monday and showed just how much this volatility is what we want to see. But if you look before August and how the VIX was performing, we saw these movements around, again, not necessarily peaking too much apart from March. But of course, since August and the Eurozone issues, we've seen this VIX volatility chart absolutely spike all over the place. And this sort of volatility has bred these markets to be totally and utterly unpredictable. So the old cliche that we always say, and which pretty much is been makes us sound like a broken record recently, is that these markets hate uncertainty. If the markets hate uncertainty, it's not necessarily such a problem for us as traders, because traders, we want that uncertainty, we want that volatility. It's how we can place trades, and just by looking at this Fibonacci level that we've got at the moment, we've seen that break that 61.8% because of that uncertainty of what's been going on, and then now we've seen a turnaround because the markets just don't know what is good and what is bad news. The move was on the back of Berlusconi and this Italian problem, the bond yields going above 7%, and that, of course, is they talk about over 6.5% being the danger zone, so 7% being unbelievably high. And of course, we've seen Berlusconi saying he's going to leave his post. We've seen the same sort of issues in Greece. But I think overall is no one necessarily knows what is good news and what is bad news. I think this is the big issue that the markets have at the moment. Again, as I say, not necessarily such a big issue from a trader point of view, because we want that volatility, but whether it's good news that Berlusconi is going and there'll be a new government in place, or whether it's bad news, I don't think that it necessarily matters. And if you strip everything out of what's been going on over the last few weeks or so with this Eurozone issue, what's been going on in Greece, I think you end up coming back to the same point of we're in exactly the same place we were 3 weeks ago. The thing that we still want to know about is, what are the details of this bailout plan? How is the money going to be raised for the ESFS? How are these banks going to find this 10 billion, overall 100 billion euros that they need to recapitalise? There are so many questions that remain unanswered, and this is all about the bailout plan. And we still had these questions 3-4 weeks ago. And even though we've had talks of a referendum that then didn't happen, we had Greece, Papandreou leaving, not leaving, then leaving again. We're now waiting for a new leader there. We're waiting for a new leader in Italy. It doesn't necessarily matter. The same things are happening. It's caused more volatility, but we've got the same issues, and the same big questions remain as to whether we're going to have this. The problem solved, and I think this is the big problem. China was a big talking point this week as well, of course, because one of the big things about raising the money for this ESFS 100 or trillion euro bailout fund is that where were they going to get the money for that from as well? And one of those big countries that everyone was thinking was going to help out was going to be China, and it turns out that China aren't necessarily that willing to help, which is not necessarily too much of a surprise, because of course you've got around the world, you've got growing problems with the electorate in these countries totally against any sort of bailout. Even within the Eurozone, you've got these same issues where austerity measures aren't getting voted through, and no other country wants to help anyone else out. And it's not surprising when you go cap in hand to China on the other side of the world, that could quite easily slip away from all this situation, that of course they said no. But of course, from an export point of view, it definitely makes sense for the Eurozone problem to be sorted out for them. But again, they don't seem necessarily too forthcoming. So this is the issue that they're going to have. Bear with me just 2 seconds. Okay, yeah. So China is so China not getting involved is going to cause yet again more of a problem. But this is where, of course, we want this. We don't necessarily want the Eurozone problem to continue. And of course, there was a certain person that was on the BBC that got in a lot of trouble for saying things like that. But it is the volatility that it causes which is nice. And earlier in the week, at our earlier webinar, we did talk about just big levels, these big trading levels that we look for. And I'm a big advocate of keeping things simple when it comes to trading. You can very easily bog yourself down with too many indicators that mean pretty much nothing, and they can all contradict each other, and you can sit there deciphering charts and not actually placing any trades, and that becomes a big problem for a lot of people. So keeping things simple is a big point. And what we've had today, and earlier on today, we're looking at this chart, and we've got this big. This is only the last couple of days or so from late last night or yesterday until today, and this was holding up, and there was quite a few trades coming through around these sort of areas around this 59.40, 159.40 level on cable. Today, of course, what we saw was the UK rate decision come out, and again, no change, no movements on the QE again, which what was expected, but it gave us a move, broke us through this level. Now we're seeing this move to the upside. We're going to be looking for a move up to around this sort of level here. Again, getting closer to some of these highs from yesterday, of course, that we're looking right back up here for the major highs, but we've got quite a few levels on the upside which are going to act as resistance on the way up. So we're going to be looking towards this level first of all as the next one after this break. There's quite a lot of opportunities down here yesterday, banging around on the top of that 159.37 to be precise, but 159.40 level. Again, now we're looking 159.70, which is the next level on the upside. Again, you look for a break there. We've got all of these levels on the upside. Again, I'm just putting these lines on for you now. All of these levels on the upside, which are going to act as some kind of resistance as we go up. And of course, the major one we'll be looking for at the top of this will be the highs from yesterday, which are up around here. So that's where we're going to be looking. It's quite optimistic to say we're going to get moves up to there, but of course, how the market reacted around that lower level for most of today has been quite a big indication of how the markets may be looking to trade as we go through. And of course, with a number of these levels there, it gives us a big opportunity. What we've also got under here is the RSI. Now, this is whether you believe this works on a more shorter term time scale is up to you, and of course the same as any form of TA, it is always very subjective, so you can either choose to ignore or not ignore. Totally up to you. But RSI is moving around all over the place, getting close to this 70% level. So again, maybe using it with something else. And those of you who don't know an RSI or how an RSI works, it's a relative strength index. And it basically is an overbought and oversold indicator. Works fantastically well in choppy markets when the markets are uncertain, like what we've got at the moment on a lot of these currency pairs, especially over the last few weeks with the Eurozone crisis. So the way it works, when you get to around this 70% level, that is an overbought indicator. Any break above that level is seen as a selling signal, and then vice versa on the way down. Oversold signal is below 30%. So any break below 30% again is going to give you that buying signal. So we get market spiked on the back of this numbers today out of the Bank of England. Getting close to that 70% level. Looks like we could get close to that 70% level, up around that 59.70 resistance level as well. So keeping an eye on that, whether the market's going to bounce lower again. That's going to be our real trigger point over the next couple of hours or so to see if we push towards that. But the UK, this brings us on to a little bit more about the UK and what we've seen this week. I mean, the UK economy has been moving around pretty. It has had a lot of news recently, which again has been a little bit swept under the carpet because of the Eurozone. Almost becomes a time for a lot of these economies or a lot of these countries to get anything they don't necessarily want to hear and sweep it under the carpet because of a lot of what's going on in the Eurozone. Now, what we've seen over the last few weeks, it has been this extension of the quantitative easing, extension of QE, and we expect to see more. I didn't see any more today, and didn't see any plans for any more. And of course, we have to wait until the meeting minutes to see what the votes will be. But what we've also got next week is the inflation report in the UK. So that will give us an idea of or the Bank of England's forecast on inflation. The inflation level, which they have been saying for such a long time is going to come down very aggressively. Now, we've been moving higher in this a lot recently. We've gone up to 5% now. But all of the time, we have been warned by the Bank of England that this is going to be the case. Every time we hear an inflation report, they have said inflation will move towards 5% towards the end of the year. And after that, we will start to see it fall pretty sharply. And again, that is what is expected to happen in 2012. But 2012 has really been touted as this magic year for the UK economy. If you were to listen to George Osborne and listen to the Governor Mervyn King as well, they've been talking that this is the magic year for the UK because inflation is going to come down aggressively, unemployment is going to get better, and the growth forecasts are going to be there. But of course, what we didn't expect to see when all that was coming out was the fact that we were going to get more QE. QE, and the fact that we could be putting money into the IMF to possibly help out what's going on in the Eurozone. So there's a lot of talk about exactly if the market's going to do anything, if the economy is going to live up to its expectations over the next few months or so. And I think it's a pretty big question out there. But the biggest issue it does have is the fact that we have this this issue with the quantitative easing, because it almost generates this false economy, if you like, this shot in the arm for markets a little bit, I imagine, but for the economy in general, and it will show maybe a more positive view. Just to break away from this a sec, you can see this. We've got that cable trade chart on there at the moment, really approaching this level, just gone above this 70% RSI level as well. So that's giving us an overbought signal at the moment. Of course, you have to be very careful with this RSI thing. A lot of people think on a more shorter term scale like this, it's not such a great indicator. Definitely needed to be used with everything else, but this is definitely a resistance level on the upside at the moment. Anyway, coming back to UK stuff. So I mean, the fact that this QE may well generate a little bit more of a worry about whether the numbers we're going to get are going to be false numbers, and it's all well and good to continue to boost the economy that way, but we want some numbers about real growth, real levels which are not forced upon us by the fact that we keep boosting the spending power of the UK. So it's going to be interesting to see. Many people don't expect to see any more QE in the first quarter of next year, but they do expect to see it maybe second quarter, even third quarter, and continuing this. Again, a lot will depend on growth figures, how everything continues to go, how the Eurozone goes. I think that's going to be a key one as well. So a quick question's come through there. The RSI, is it set to a 14-day period? Yes, it is. Yeah, that's set to a 14-day period. I tend to keep it the same for the majority of charts. Okay, so it's going to be a key thing to see if this QE is going to be the major thing which continues to cause the issues. But and moving away from the QE and going back to the Eurozone a little bit, the Eurozone is going to be our big problem. We can't necessarily get away from that, and we can't get away from the uncertainty. And quite a lot of times around this time of year, you get quite a lot of people asking about the outlooks for next year, the outlooks for the close of the year to start off with, and then the outlook for next year. But of course, we were looking exactly the same sort of thing at the end of 2010. We're saying what was going to be the big topics for 2011. At the start of it, no one said it would be the Eurozone the Eurozone debt crisis. We thought that was very close to being sorted out because we'd had bailout plans which had started to solve these problems, and it was almost saying to us, well, that don't worry about the Eurozone, the bailout plans are solving the issues. Now, of course, we know that isn't the case, and there is so much more skepticism around this now. Every time we have a bailout, every time there is talk of a bailout, and this one, of course, is this three-pronged attack on the problem. People are far more skeptics about it now than what they were before. So I think not many people think that this is going to solve the problems. It could be the shot in the arm that starts to solve everything. Of course, the Greek officials were saying this is a new time for Greece, and that the problems were going to be there. I still think many people think that we are going to have the only way for this Eurozone crisis to go away, it will be to get Greece out of it, although to get Greece out of the Eurozone. And the problem is, if you do get Greece out of the Eurozone, you've got Italy next, you've got Spain, you've got Portugal. How many do you kick out? And we've had German officials today coming out, talking within the market about the fact that they're not looking at this plan for a smaller Eurozone. That's something that's been touted around. But this referendum really would have been that vote. It would have been that vote for Greece. If they would have said no to this bailout plan, it would have been a bankrupt Greece, and it would have been them out of the Eurozone, and it would have been a vote to say, do you want to be in the Eurozone or do you not want to be in the Eurozone? And I think that was a worry, and that's why it had to be cancelled in the end, because although that may be the truth and it may be the way things things work out in the end. I think it's almost one of those things that we'll cross that bridge when we get to it. Now, fortunately, we're getting very close to that bridge, and it could be the case that we can't do too much to stop that now. So it could be a case that you look through your old drawers at home and see if you've got any of those old drachmas in there from past holidays, because it could be about to be worth something pretty soon. Okay, so I mean we've gone through the majority of things, and also looking at this cable chart as well, we are holding up around that 59.70 level at the moment, and we have seen a couple of moves to the downside. So again, looks like that number for now is holding us up. Won't necessarily for too long, but for now it's holding us up. But that's been the weekly roundup. We're going to have a little look through some of your questions now, so give us a couple of minutes, see if there's any questions. If you've got any more questions, please post them to us now. If we don't have too many, then we won't keep you on for too much longer, but bear with us just 2 seconds. Okay, there's a few questions on here. One of those is, where can you get a free VIX chart? Now, there's the VIX chart I get from, well, the one I showed you was from Bloomberg, but you can get them from quite a few places. There's a charting website called Pro Real Time that will give you charts. I'm not sure if it will give you the VIX chart, but it's worth a look on there. There's also a charting website, free charting website called bigcharts.com. That's something that I've used quite a lot of time throughout my career. So going to bigcharts.com is always a good. You're likely to get some good points from there as well. There's also another question here saying, will there be negative implications in the near future to the fact that the ECB is back in the markets today, buying Italian government bonds? Now, I think this is an absolute inevitability when you've got the 10-year bond yields up around 7%. Something needs to be done. Of course, they can only do it in the secondary market, so it doesn't have straight away move this yield any lower. It's a good question whether there are going to be negative implications. I think no one knows what's negative and what's positive at the moment. The only thing that will be seen as positive is if it starts to bring this yield lower, and that is as simple as it gets at the moment. It's anything that brings that 10-year bond yield down below 7% and back to around 6.5, and it's amazing that we're saying 6.5% on a 10-year bond yield is an acceptable price. But anything that brings it back to down around there is going to be seen as positive news, and it looks like, I mean, you look around these government bonds at the moment, and the UK 10-year with its yield at around 2.2% is coming in as a bit of a safe haven for the bond markets at the moment. And who would have thought, with the UK with its own pretty dire economic problems, that their bond yields would be seen as a safe haven at the moment. So again, shows you that the world we live in nowadays, and the markets that we trade in are nothing like we've seen before. Okay, it seems like we've covered off all of the questions. So just like to say thanks very much for joining us today. We have webinars next week. So I'll just get you up there you go. There's the webinar schedule. So next week, 15th, Psychology of Forex Trading. These two won't be done by me. This will be done by George, who's another analyst here. He will also do the weekly market roundup next week, next Thursday. So please register for those. Also, we've got the World Money Show tomorrow. This is being held at the QE2 Conference Centre in Westminster. I will be doing a talk on technical analysis and Fibonacci. So please come along. It's free to come along to that. You just have to register for it. Hold on, let me just find out what time my seminar is. It's at 1:30. So I'll be speaking at 1:30 at the QE2 Centre. So please come along if you can and you have time. Next week I'll also be doing a show for those of you in the US. I'll be doing a show in Las Vegas at Bally's. So I'll be speaking on Thursday and Friday, once on Thursday, twice on Friday. So again, those of you in the US, if you can come along to that, please come along. Again, it's free to register. These are both World Money Show events, so they are pretty well-run events. If you can't come to the talks that I'm putting on, try and come along. We have stands at both of these events. We have a big stand in the UK, so on Friday and on Saturday. And also George will be talking in the UK on Saturday as well. The show runs for 2 days, so please come along. Please come along if you can, and it will be nice to see you there. Apart from that, thank you very much indeed for coming to today's webinar, and we hope to see you again soon. Thank you very much indeed.